It's a pleasure to be here today. It's February 2nd, Wednesday, 2022, with three really serious experts on macro labor markets. Michael Burda, who's a professor at Humboldt University, Berlin, and of IZA Research Fellow and Program Director. Pierre Cahuc, professor of economics at Sciences Po in Paris, also an IZA Research Fellow and Program Director. And Harry Holzer, who's professor of public policy at Georgetown University and an IZA Research Fellow. Thanks you for joining me this morning, gentlemen. It's a pleasure seeing you all again. And let me start off with a question directed to Pierre, since he illuminated what I hadn't known, namely that in Europe, he told me, the labor force participation rate, the fraction of people working or looking for work, has already risen back to its pre-pandemic level, whereas in the US, it is still about 1.5 percentage points. That's about 3 million workers below where it was. Pierre, why the difference, or why is this happening in Europe right now?
Well, you're right. So there has been a huge drop in the participation rate during the start of the pandemic in March. Okay, in the euro area, it decreased by about 2 points. Okay, but now you're right. It's higher than before the end of 2019. It was about 73.89. It's about 1 point higher, and it's the case almost in all countries. So I think there are two reasons to that. Mostly, one of the reasons is that we had schemes that help people keeping their job during the pandemic, especially short-time work, which was really widespread in many countries. This is so people didn't lose their job and remain on the job, so did not quit the labor force. And the other reason is obviously all the expansionary policies that helps to sustain activity, which is also the case in the US, obviously, but combined with these schemes, these short-time work schemes, it seems that it has been quite effective at keeping people in the labor force.
Harry, any thoughts about the US, why we're so different from all those European countries?
Yes, well, Dan, like you said, we're down about 1.5 points in labor force participation. About half of that is early retirement among people 55 and above. I think driven heavily by rising asset values, rising stock values, perhaps on top of remaining concerned about their health. But the other half, below the age of 55, is somewhat more heavily female caregivers who have other responsibilities, and perhaps, and of course, the big difference between the U.S. and Europe is that we don't have paid family leave. And those kinds of policies nearly as well as Europe has. But of course, the other thing in the United States is not just labor force participation. It's also for people in the labor force, their greater reluctance to remain in jobs and to accept new jobs. Some people call it the Great Resignation, very high quit rate. But it's not just that. We also know that they are more reluctant. The vacancy durations are longer as well. And people are reluctant for a lot of reasons to go back to the jobs they had before. There's a lot of reasons for whether they can sustain that when their savings start to wind down. We'll see. But in the meantime, people are more reluctant and they're demanding more, and employers are starting to respond to that.
Michael, any thoughts on this from your, I think, transatlantic viewpoint?
Well, I just like to support what both Pierre and Harry have said, but I think the Europe story is not as homogeneous as one would think. And I've spent the whole morning trying to thread the data. And if I may, can I share my screen? Can you let me share?
Sure, please do.
Okay, I'm gonna, if I may, just take a look at this difference across European countries. And I'm going to have a surprise for most of you, because a lot of you probably don't know this. I know Pierre's looked at these numbers. This is the story USA versus Euro area. So Pierre is right on target. There's been a huge surge in activity, as the OECD calls it. The United States is still under. And if you break it up by man and versus woman, it's actually quite different. But if you look at the individual countries, Denmark, Spain, Poland have all reached or exceeded their previous highs. France is way above its previous peak. Whereas Germany, with this incredible short-time work program, in Italy, and I'll show you another surprise, the UK are actually way below. So those countries look a bit more like the United States, whereas the Scandinavians and the Southern European countries, surprisingly, with the exception of Italy, Greece, surprisingly. So my interpretation is here that, there's a combination of two effects. One is the wealth effect. The Greeks really want to get back to work because they have lost so much in the past 20 years or 10 years since the Euro crisis. And the UK, maybe we have some of the Harry Holzer wealth effect going on, but in Scandinavia, people are so secure in their activity, labor force participation, that this is really, consider Denmark or Sweden, where the death rate has been higher than in Germany and many other countries close to the United States, actually, cumulative deaths. It seems like people have a different attitudes towards risk versus return. So this heterogeneity is just blowing me away. I mean, the fact that Poland is way above and France is also way above. So maybe those countries have some catching up to do.
Thanks very much. Let's unshare, if you would. And let me move on to a different question, which Harry sort of alluded to, and that is 3.9% unemployment, vacancy duration longer than it's been since we started collecting numbers on that in the US 22 years ago now. Unemployment real low. So why haven't real wages been rising more, darn it? I mean, is it just a typical American thing that these are lousy jobs and we don't want to? Harry.
Start with me. Okay. Well, so first of all, to be fair, there have been some increases in nominal wages. For many, many years, we were stuck in the 2 to 3% range on nominal wage increases. It has gone up to the 4 to 5% range. So that's not a trivial increase. Of course, when inflation is running 6 to 7%, it's not quite as much. And we hope that those inflationary expectations don't get built into wages. But there has been some response. And again, if it lasts when inflation comes down, that'll be a good thing. But I think what limits the wage increases, at least in the US, from an employer point of view, and employers, public companies have to respond to their shareholders who like very high profits. They try to respond initially in the way that has the least effect on their bottom lines. So like the first response in many cases is bonuses, signing bonuses, which have no effect on the stage. In many cases, I believe that's probably insufficient. Then they try certain improvements in fringe benefits. A popular one is providing support for college tuition, knowing that many of their workers will not take that up, especially their incumbent workers. If that proves insufficient, then they might have to do other things like actually raise the wage or other benefits that matter. So again, we'll see as this goes on for longer. I think there will be more pressure on them to do more substantial things that actually do show up in wage rates.
Michael, any thoughts about wages in Germany, which is a totally different system, I realize?
Well, I've kind of flipped the flag. I'm kind of a monopsony guy now. I really do believe that firms have lots of power. Even a search model with a reasonable specification gives firms a little bit of frictional power in setting wages. In Germany, we have employers associations which really collude openly to set wage structures. Denied every day, but it's true. And in the United States, you have non-compete agreements and all sorts of other crazy stuff that just locks in monopsony power. And I think it will come into play at some point. What you do see is at the margin, where labor markets are tight, where the vacancy to unemployment rate is high, wages are moving. And there's a lot of evidence that's even so in Germany. And of course, when employers complain, something's wrong. So that's the first secret, is to listen to the employers complain.
Pierre, any thoughts on this, France or Europe-wide?
Yeah, I agree with what you said. I mean, labor markets are on average less tight in Europe than in the US. And actually now that unemployment is declining, we do see wage starting to increase. Eurostat data show that there have been an increase in labor costs that has accelerated recently in the euro area. So we are just at the start of a kind of new era. And we know that there are some lags in wage adjustments. If I look at France, usually we have wages that are well connected to productivity, and even that goes even faster than productivity quite often. So there are many debates in France now about increasing wages. And as you know, in France, wages are really very strongly influenced by minimum wage. So it will depend on the policy of the government, whether the government increases minimum wage. I think that until the next presidential election, there is no big change on this front. But after, it could be, depending on who is elected, that we'll have a strong wage increase.
Right. Okay, let me ask you this, as we've mentioned the I word here. Inflation. How has the pandemic, Michael, contributed to that? I mean, is it just the indirect result of pulling out of people from the workforce and coming back in? Or is there something more labor market related? Or is it just a spillover from the so-called supply chain business, which I don't understand at all, by the way?
Well, I think, you know, during the Great Moderation, people in macro labor have been preaching the notion of a flat Phillips curve. In fact, there's some very influential papers have come out that just said the Phillips curve is almost perfectly flat, which cannot actually be true. I mean, Robert Lucas is yelling in his office right now, but more importantly, people who have long Milton Friedman. You know, there is some evidence that what we're seeing right now is a supply shock, meaning that a relatively flat Phillips curve shifted in a violent way because of the pandemic's restriction of supply chain activity and just reducing the availability of stuff. You see it in Europe. I mean, I go to the bicycle shop and there are no bicycles, right? And it's crazy. They have one bicycle. You can look at that. And this is obviously a temporary thing, but if people start raising prices in a concerted way, and I think there's some evidence of that, this will be passed on whenever workers can get away with it and where they have bargaining power, and then this will be passed on. And, you know, right now the banks are sitting on all this unlent reserves. And as I see it, it's just money waiting to be activated and become part of the money supply, and aggregate demand will certainly rise to the occasion unless something happens. And I just don't see Europe raising interest rates. So we're probably moving into a phase of higher inflation, shifting Phillips curves. And if that's the case, it's going to be very painful to get it back under control.
That's very depressing, and
Thank you.
Pure macro stuff. I don't understand it all. Pierre, thank you for that. Pierre, any thoughts on the productivity issue in particular in relation to that?
No, I agree with what Michael said. So given that the core inflation is really less important, I think, in Europe than in the UK. I mean, UK is almost not in Europe anymore now, and than in the US. So I think we have to once again to wait to understand what will go on. So once again, I think that in a country like France, the policy of the government will be very important. We could have a wage price loop that will increase inflation and that will disconnect wages from productivity if political pressure is important. But so I think that in a country like France, since wages are so much determined by the public policy, by administration, and we have to be aware that we have this minimum wage, but we have all a set of wages that are set at the industrial level that are almost connected to the minimum wage because we have extension of collective agreement by the administration. So everything is almost a matter of political decision. So I think it will really depend on how policy evolve on that front.
Harry, any thoughts on this productivity issue? Or
well, on the inflation side, inflation is higher in the US than in the EU. And Jason Furman has tried to construct some comparable series. And the inflation rate in the United States is running about 2.5 percentage points higher, which is quite a bit. We share the supply chain problems with Europe. So the question is, what else is going on here? Part of it is the labor story that we've already talked about, that the labor pressures are higher in the US. I think the other story, frankly, is that we don't just have a supply side problem. In the United States, we have a lot of demand because there was so much fiscal and monetary stimulus. And on the fiscal side, and I will be a little more critical here, some of the early relief was very, very necessary, and I think was quite successful. But we passed two relief bills, one in December 2020 and one in March 21, that combined pumped another $3 trillion of fiscal stimulus into the economy. That's another 15% in an economy that was already recovering. That was a lot more than was necessary. And of course, it's not just that all that stimulus was pumped in, but it was also shifted in the direction of goods, because people aren't out spending as much on services. So it's not then too surprising that we have this big imbalance between higher than expected demand and lower than expected supply. And I don't know how quickly we'll solve the supply problems, but I do think some action on the demand side is necessary.
I agree completely. That's if you look at the U.S. personal disposable income series, it really literally has recovered trend because of these transfers. In the EU area or the Eurozone, Euro area or the EU, it hasn't anywhere close to it because growth has been very meager actually. And basically the US just went to the bank and just, huge. I mean, it's a real experiment. It's going to lead, like Harry said, to a demand effect, and people are putting it into durable goods. There's no question about that. The price of used cars just skyrocketed. Right?
Yeah.
Very depressing. Pierre, let me ask you, any thoughts on this one at all?
I'm sorry.
Let me ask you this. Let's say, certainly in the US, and quite frankly, our inflation is going to spill over to Europe too at some point. Okay. At some point, even the United States, even with all the people who think that printing more money doesn't cause any problems, of which there are a lot running around this administration, I understand. Eventually, we're going to tighten up. We can't have this tremendous demand at a time in which supply is restricted. We're going to tighten up because there's tremendous political pressure to solve inflation here, and it's going to affect you guys too. Okay. What's going to happen to unemployment then? As a result of that? Pierre, any thoughts? And let's go around.
Yeah, so as you know, unemployment is going down, and actually we are at the lowest level on unemployment in the Eurozone since 1998. So on average, so it's not obviously perfect in all countries. If you look at Spain, Portugal, or Greece, we're around 15%, but in many countries it's much better. Even France is not that good, it's about 8%. But nevertheless, we are perhaps in one of the best situations to tighten a little monetary policy and to try to act on inflation. So I do not worry that much at that point, especially because also I think that government have incentive to have little inflation to dampen the cost of big debt. And so it could be that we are going to live in a world with like 4% inflation per year, and most people could be happy about that or could agree on that. So I do not worry that much, especially because of the situation that is better now. But obviously, this is a dangerous game, and we have to see how it will go.
Harry, any thoughts on this? Are you not as pessimistic as I am, maybe?
I have some hopes and I have some concerns. I think the Fed is signaling that it will do the right thing, and by the right, they're not going to slam on the brakes, but they'll be pumping the brakes, slow but steady increases, which I think is appropriate. And the hope is that we'll get a soft landing out of this. The hope is that we'll start to see some progress on the supply side. Gradually, we'll rein in the demand pressures, and that combination will work. But there's always the risk that won't be sufficient, and that we'll end up with more serious actions that could cause a hard landing. One of the things, a little bit outside my purview, but I imagine Michael and Pierre might know more about, since we've had low interest rates for so long, there's parts of the U.S. economy that are very heavily over-leveraged. And there is some concern that with interest rates, if interest rates rise quite a bit, and this is especially in the unregulated parts of the financial system, we call the shadow banking system. And there's, if interest rates are forced up sufficiently, that you could have a bit of what they call a fire sale in those sectors, and that could have negative repercussions. So as I said, I have some hopes that we can get a soft landing and do this slowly but surely, but some concerns as well if that doesn't work.
Very good. Michael, any thoughts on this? And then I'm going to ask one quick question to everybody going around the table after that. Michael, go ahead.
Okay, yeah, I kind of stand in the same corner. One thing that kind of concerns me is that productivity is in Germany at least, and probably in France as well, because of all the short time stuff. Firms are really not very productive. Unit labor costs have risen, and this is usually a bad sign. I mean, if you look at the great inflation of the 60s, it was preceded by a big rise in unit labor costs, which usually comes because productivity just doesn't keep up with wages, but it's falling because people, you moved into a recession and people don't get laid off quick enough. In the US, I saw that productivity per person actually went up in the recession, but I think that was probably just a compositional effect. But that must feed back onto prices at some point. So that's kind of bad news. Again, more bad news, but also in Germany and other parts of Europe. What I'm concerned about, and I'm so optimistic as Pierre is that the Germans are going to really start putting pressure on the European Central Bank to raise interest rates. I think it's inevitable because the Germans have this inflation psychosis. But when they do it, and if they try, there's going to be big resistance from Southern Europe, because Southern Europe is highly leveraged, like Harry spoke of, but these are governments. So when Italy starts to face a really serious positive real interest rate, there's going to be a lot of tension and worries and maybe a threat to the euro. So this is like 5 years down the road. That worries me a lot. I stay up at night thinking about this.
All right, guys, let me ask you a bit of economic history in 2 sentences each, okay? You've all been observing the economy for 40 plus years, okay? Question is, let's go Michael, Harry, Pierre. Michael, give me a time in the last 70 years in which the macro labor market is most like or was most like what it is today.
Oh, that's a tough one.
This is not a left field question.
I would say 1973. Just when inflation started to take off. I mean, if you look carefully at it, this is kind of my favorite, because I was 14 years old. I was starting to get into economics, and especially monetary economics. I was buying all these books on the Fed. So, this was a big dilemma for the US back then, and Arthur Burns and all that stuff. So that would be my comparable picture, but maybe I'm just too young.
But there was a supply shock, remember, too, in 74. Okay, 72.
No, the supplies, it started in 73, Dan. Remember the Russian wheat disaster? And then
I remember, but the real supply shock was the oil prices.
Of course, and that was 73, 74.
74, and right after the Yom Kippur War. Harry, what are your thoughts on an analogy, or am I being too naive to think about one?
Well, as you suggested before we went to tape, right after World War II. Now, that's slightly outside of your 70-year window. I understand that's the 75-year window. But you had a similar case where there's a lot of pent-up demand from the Great Depression and the war, and there was a burst of spending, and it did take a few years to get it under control. And so that would be my relatively hopeful scenario that we can bring it back under control, but whether we can do so, and again, since I have some sympathy for the workers wanting better pay, we'll see. I would hope that our productivity might improve. I hope we do better on the education and training side, maybe to try to bolster productivity over time. We'll see if that works.
Pierre, let me finish with you. What's the analogy, if any?
Okay, I feel like a bad pupil. I don't see any. I think that it's really very specific. I mean, this pandemic is a very, very different shock than the one we had before. There is a huge amount of private saving around. There are huge public deficit. Nothing has been really destroyed, like it was the case in war. It's not a big supply shock. So I think it's really, really something that we never know. And so that's why it's difficult to figure out how it will go. And you can see that from the fact that now in Europe, actually, the economy rebounds very, very quickly. And like 6 months ago, all people were saying, well, it will not happen. It will be very slow. So I think we are really in a new world. It's a kind of new event. So we don't know. Sorry for that.
That's quite all right. This is kind of what I expected. That's the whole problem in this business. We try to learn from macro in the past, and I'm not sure how much everything tells us. Anyway, gentlemen, Harry, Michael, Pierre, thank you so much for being here. So insightful. I learned a lot, and I got even more depressed from listening to you than I was beforehand. Thank you.
Thank you,
Thank you
Dan.
very much.
Nice to see everybody.
Bye-bye.
Hi, everybody.
Nice to see you.
Bye.